Well, welcome everybody. Thanks for joining us for a mid-year outlook here to both discuss the volatility, the direction, the dynamics of the market, and actually introduce Andrew to all of you who's been helping our firm for the better part of a year as part of our involvement with LPL research. So again, I wanted to welcome everyone, but truly I want to hand it off to my partner, Rob, have him describe a little bit more about Andrew's role with our firm, and then get going with the mid-year outlook.
Yeah, thanks, Jack. It is somewhat of a pleasure to introduce Andrew and the Chief Investment Officer role that he plays for us here at One Financial. We announced this partnership back, I believe, in April or May, where Andrew is an employee of LPL Financial, acting as a consultant to One Financial as our CIO, Chief Investment Officer. What does that mean? It means Andrew and his team work closely with us to help design and implement an investment process that relies on a research-driven approach. And we're strengthening our investment management and portfolio management with his team's help and capabilities. It means for you, as clients or interested parties, a sophisticated portfolio management, enhanced risk management, and a greater focus and dedication on you, because by outsourcing some of these investment research responsibilities to a dedicated expert, Andrew and his team, the advisors at One Financial have more time to focus on you and your unique financial needs and planning priorities. So it is a pleasure to introduce him as he's going to walk us through this mid-year outlook. Thought I'd ask Andrew a question to get us started here. It's obviously been a very eventful first half of the year. Can you walk us through what we saw happening in the markets for the first 6-7 months of the year?
Yeah, absolutely. So Rob and Jack, thanks for having me on today. I think this is a great time to discuss things. There's obviously a lot of news going on, but you're exactly right. It's been an incredible year so far, incredibly volatile year so far. And I think that we need to kind of take a step back and remember at the beginning of this year, during the first quarter, equity markets really sold off in the US. So we saw the S&P from about mid-February to the beginning of April drop almost 19%, which, and we'll touch on this a little bit later, we consider a correction. It's not a bear market, but it is a correction. A bear market's when you drop 20%. So we were nearing that point, but we didn't quite get there. Following that, though, and especially after the Trump administration announced a 90-day pause on the tariff implementation, we saw equity markets in the US just take off. So the S&P from that point on through the end of the second quarter advanced. We finished the first half of the year with the S&P up more than 6%. That continued through the month of July, and we finished the month of July with a year-to-date gain for the S&P 500 of a little bit more than 8.5%. So a complete reversal from what we saw during the first quarter. We also saw during the first quarter and during the first half of the year, international markets take off. And we'll look at that on this next page as we take a look at the second quarter returns. You can see the markets that advanced. International markets, specifically international developed markets, advanced through most of the first half of the year. They were up almost 18% through the end of the month of July. Fixed income markets continue to be relatively resilient. They provided the ballast to markets that we saw in the first quarter when equity markets sold off, and then took a little bit of a step back during the second quarter, but we did see a lot of the more risk-on parts of the fixed income market take off. So think about high yield, emerging markets, debt, et cetera. One of the key points that I want to make here and that we have really highlighted on this screen is that during the second quarter in particular, and this continued into the month of July, it wasn't like the equity markets in the US were rising and it lifted all of the boats. This was specifically a rally from the companies that were really beaten up during the first quarter. So as we divide the equity markets between size and style, what we see on this chart here is that large cap growth companies, and think about growth being comm services or IT companies out there, Those advanced during the second quarter almost 18%. So a massive rally from where they were at the end of the first quarter. Large cap value on the other side, and think about healthcare, utilities, real estate, more of your defensive portions of the market, only advanced 3.8%. That's a 14% spread, and that's significant because that means that diversified portfolios, if you had exposure to value and you had exposure to growth, you were kind of weighed upon by the outperformance and the concentration of that growth performance during the second quarter. So something to think about as we go into the rest of this presentation. There are a lot of dynamics at play. And Rob, I think we're going to touch on that in just a little bit.
Yeah, thanks, Andrew. I think part of what we're gonna talk about is we came into the year expecting rate cuts, Fed rate cuts, but that hasn't happened yet during the first half. What are we thinking the Fed is going to do during the second half of this year?
Yeah, there are a lot of moving parts here. And I think, like a lot of investors, we've been trying to read the tea leaves from what the Fed governors have been saying. And we got a little bit more clarity in the past week as Jerome Powell spoke at their conference in Jackson Hole, Wyoming. So, as we think about this, one of the things we want to focus on is the broader economy and then boil that down to where the Fed is and what they're reacting to right now. So we did see GDP growth rebound in the second quarter of this year, but not all GDP growth is created equal. And I want to be very clear about that because you could look at that almost 3% gain in GDP growth and go, well, everything's going great. But the big reason that GDP growth advanced during the second quarter compared to the decline in the first quarter is that imports declined dramatically during the second quarter. Businesses tried to front run or get in front of the tariff implementation during the first quarter. They imported a lot of inventory. Imports actually detract from GDP as we move into the second quarter. And you can see that in the chart on the screen right now. Companies stopped importing as much. So that slowdown in new orders, which we see on the chart, really results in a benefit to GDP growth because we're technically exporting more than we're importing. But the reason that we're exporting more than we're importing is not based on normal market dynamics. It's based on the expectation of tariffs coming in. As tariffs come in, companies take back their new orders. They stop importing as much. They stop deploying CapEx like they were expecting to coming into this year. So there's a lot of uncertainty, and we'll touch on uncertainty for sure in a little bit, but a lot of uncertainty from the business community, which is weighing upon the economy. If we move to where the Fed is, and Rob, that's what your question was actually about there, the Fed has a dual mandate. It's important to remember that because what we've seen over the last couple of years is that everyone's been focused on inflation. Inflation was the talk of the town during the election. As we go through all of 2024, 2023, as we entered this year, the expectation was that inflation was going to moderate and come closer to the Fed's 2% target. That didn't quite happen. It did moderate, but it started to tick higher. And what we've seen now is that the Fed is starting to focus rather than on inflation, on the opposite side of that mandate, which is full employment. And we're starting to see softness in the labor market. And we see that on this chart here. We have two different points that we're looking at. One is the hire rate, which is the vertical lines that you see. The quit rate, however, is the line that you see moving across the page, both of which have declined. But the one that we're really focused on here is the quits rate. And the quits rate means that's the number of employees that are voluntarily quitting to move to other better opportunities. That has declined dramatically. Obviously, since the post-COVID period, where it was really an employees market where they could demand higher pay and move to different positions, we're now seeing the opposite. We're starting to see companies discuss layoffs, for, and this is very key, economic reasons, not cost-cutting reasons. And those are very different from a shareholder point of view. We like cost-cutting. We don't like economic layoffs. So we're starting to see that slow down. And that job market softness is what is likely to lead to the Fed cutting rates. They're focused on, again, the labor market, not the inflation. And that's what Powell talked about in Jackson Hole. The one thing to really keep in mind here Everyone's been waiting for rate cuts, and the market is really pricing in a small rate cut at their September meeting. Even if we get that rate cut, and you'll see that on the chart here, that doesn't mean that we're going through a large easing period from the Fed. It's still going to be relatively restrictive, because if we look back, even expecting rate cuts, there's an entire generation of investors, of people, of consumers out there that really in their adult lives have never experienced rates this high. The last time we saw rates at this level from the Fed was in 2005, so 20 years ago. So we have an entire population of people out there that still see, even with a rate cut, even if we got 50 basis points of a rate cut, being really restrictive. So we do think that there is going to be a rate cut, but we don't think it's going to have the type of impact that maybe some investors are hoping for. So I know that was a long-winded approach there, but there's a lot that goes in to reading the Fed tea leaves and understanding what they're happening and what's going to happen and what we expect to happen.
Thanks, Andrew. I know we talk about that a lot in our investment committee meetings, so thanks for elaborating for everybody. But while you were sharing, you did throw out the T word. So tariffs, they've definitely dominated the news cycle this year. What are our thoughts and outlook moving forward, and what impact do we think they're gonna have on the economy and stock market?
Yeah, Rob. So this is a tough one. And the reason it's tough is because after that 90-day pause was announced, we haven't seen the effects of tariffs really filter through to consumers yet. We're starting to see some evidence of that. We're starting to see companies during their earnings call this quarter discuss raising prices, discuss having larger input costs, and that will likely at some point trickle down to consumers. So we do think that that's going to be impactful to the economy. We do think it's probably going to lead to some inflation. But one of the things to keep in mind here is that that inflationary impact from tariffs, we believe, is going to be more of a step change as opposed to a longer term inflationary period. And the reason is, if you think about this, if you're importing goods and that good goes up by 10%, you have a couple of choices. One, you can pay that 10%, it comes out of your margin as a business owner, or you can pass it on to consumers. But as long as that tariff remains at X% and doesn't go up, you don't have to increase prices again and again and again. It's a one-time movement. Now, the other thing that we need to keep in mind is that, like we said, as a business owner, if you're importing widgets, those widgets go up in price, you have a couple of decisions to make. One, you can let that impact your margins and you can eat some of that cost. Two, you could send it off to consumers, let them pay the price. The other thing is consumers have options. Consumers can not buy as many widgets as they were previously, or they can move to a different widget provider to go back to my economics days in college talking about widgets. So there are a lot of different moving parts to these. We don't see tariffs, and obviously they are being implemented, but we don't see them leading to a recessionary environment in the US. And I make that clear with this slide here. We don't see that becoming a big problem unless kind of the global average effective tariff rate reaches more than 20%. That's kind of a bright line for us where it becomes problematic at 20% plus. But right now, what we're seeing are tariffs in the kind of mid to high teens. And that is not ideal from an economic perspective, but it is also something that is manageable by the economy, both from investors, and also consumers, because like I said, they can move on to different widgets or purchase fewer widgets. There are ways that businesses can mitigate the effects of tariffs. And the way they do that is, again, changing supply lines. They can move to sourcing from different countries, different regions, et cetera. They can also use free trade zones, which are economic areas where they can route shipments through, which will alleviate some of that tariff pain. The other thing that they can do is work with the government, and specifically the U.S. Trade Representative, to negotiate some exclusions from tariffs for their products. So there are ways that businesses can mitigate that, as long as we don't get to a point where we are at a 20+% tariff rate on a global aggregate scale. Then we think we're probably okay. But the real thing here is that, look, tariffs are going to be impactful. Absolutely, they are going to be impactful. but we don't see them impacting the economy to the point where we become in a recession. And that's the key for investors as we move forward. And I think that's kind of where we're headed next, Rob, is where are we going when we move forward?
Yeah, it certainly tariffs are dominating the news, but through the end of July, the S&P 500 is up more than 8.5% for the year. So hasn't translated to market sustained market declines, I should say. Where do we expect the second half of the year to fall? Do we expect a continued bull market, or is there some volatility on the horizon that we should be preparing for?
Yeah, I think that this really goes to the point and kind of the description that we use, which is a cautious optimism here for when we look out into the second half of the year and even further. The reason that it's difficult to say exactly where we're going is twofold. One, there's a lot of uncertainty still in the marketplace. There are movements daily from the White House, from the administration about tariffs, about trade policy, and that's going to weigh or support the market on any given day. So the market's being led a lot of times by headlines as opposed to hard data, which is something we'll touch on when we talk about the investment committee. That's one of the big things. The other thing is just this uncertainty that we're seeing in the marketplace weighs on consumers and weighs on investors. And you see that in the chart here. This is the policy uncertainty index, and it is tracking the number of times that uncertainty regarding policy is mentioned in the press. We have hit a point of uncertainty that is really unheard of. We saw that during COVID, but if you think about this, we were experiencing a novel virus that was potentially killing people, that we didn't really know what was going on, if there was going to be a cure. There was all this uncertainty during COVID. We have the same level of policy uncertainty now as we did during that period. So that's really become a weight on consumers and on investors, but we've still seen the market advance. And that's because we've still seen earnings from companies be incredibly resilient. Margins are expanding. Earnings expectations are being beaten when we go through the earnings periods. So, that is propelling the market. The other thing that we try to do as researchers is go back to previous periods. We try to find an analog. When has this type of environment existed in financial markets previously, and how did investors react? Unfortunately, right now, we don't really have a great analog. The last time we saw this level of tariff imposition was in the early 20th century, in the 1920s. If you remember Ferris Bueller's Day Off, Ben Stein talked a little bit about that during a scene there, but there is not a lot of an analog there for us to compare this market to. But what we can do is look at where we saw previous market corrections. And we talked about that at the beginning. Market correction is a decline of more than 10%, not more than 20%. We saw a 19% decline earlier this year from peak to trough. If we go back 75 years, so to 1950, and look at all of the corrections in the S&P 500 over that period, so corrections, not bear markets, not recessions, what we see is that in the trailing or in the following 6 and 12 months, 91% of the time, both of those periods, so from the trough of the correction, the next 6 months, the next 12 months, 91% of the time, there have been positive returns after that period. And those returns, on average, are almost 10% and a little more than 16% over the 6 and 12 months following that trough. So, not saying that we're going to get that. We don't know that we're going to get that. I think that we are a little bit hesitant to expect that type of a rebound as we go forward. We see a lot of volatility based on that uncertainty, based on what's happening in the marketplace right now, based on how we expect the labor market to soften. We do expect a slow growth period in the US, not a no growth and not a decline, but a slower growth period than we had in 2023, 2024. That's going to impact markets. It's going to impact companies. But we overall have a relatively optimistic view. We do think that companies remain resilient. They do have upward margin pressure. So that is good for them. We think there's going to be volatility, but we have a relatively optimistic view. And I think that one of the things that we try to do in our investment committee meetings is not be led by the headlines, not be led by politics. We want to make very clear that we're not focusing on politics. We're not letting those types of things come into our into our IC discussions, because it's very emotional, and we don't want emotions to be dictating what we're doing with client portfolios. So we're focusing on hard data. We're focusing on survey data to show us where the markets are heading, where opportunities may exist, and we're discussing those dynamics on at least a monthly basis. And that's where we're making decisions. We're doing so rationally. We're following a process, and that's really important, especially as we enter the latter half of this year, where we see a lot of volatility. So, Rob, I know that you wanted to discuss that a little bit more, but I think that's a big key for investors and for clients as we look forward, is that we're taking a rational approach. We're taking a process-driven approach, and we're doing so on a regular basis as a team and as a group that comes together to talk market dynamics, market outlook, et cetera.
Yeah, thanks. And we do meet frequently together as our investment committee, and we discuss all these things: economics, geopolitics, investment markets, in a lot of depth, making sure that we're informed about where our investments stand, what obstacles, perhaps opportunities may be present. So it's been very helpful to have you and your team be a part of those investment committee meetings and direct some of that research. So we appreciate it.
Absolutely. And we actually have one later today. So looking forward to the conversation as well.
That we do. I do not know that we offered questions as part of the webinar today. So if anybody, Andrew, do you have the capability if somebody raises their hand or to unmute somebody if there is a question?
I do. I am going through and allowing folks to talk now. So we will.
Okay. And
open it up.
Yeah, while you're doing that, if there's anything that you could share to give us a little bit more clarity about, the questions that I hear a lot, and this isn't, we're not going to get political about it, but, these tariffs, and it appears that they are starting to generate revenue for the U.S. Treasury. Is this, the views, I guess, is this going to be a sustained policy? Is this helpful for our country? Is it going to create this, the pros and cons, I guess, if you could speak to that a little bit.
Yeah, I think that there are, look, there is revenue being generated from the tariffs. Absolutely. The question is, who's paying the revenue? Where is that revenue being derived? Is it coming from the consumers? Is that going to weigh on consumer sentiment? There is absolutely no doubt that tariff revenue can impact the debt for the United States and impact the deficit. That is a positive thing, potentially. If they have a material impact and weight on consumers, and that places more pressure on consumer spending, then overall the economy is going to react. And so that could be a potential negative. I think that your question, and one of the points we want to make, is that very frequently policy directives out of DC are negotiated, they are fluid, and that is no different this time. There are consistent negotiations going on between various countries and the U.S. Trade Representative. Those are being talked about in the news, but a lot of those negotiations are happening behind closed doors. So as we move forward throughout the year, we do expect to see some breakthroughs, some deals being signed that could potentially lessen those tariffs. Again, we're looking for those tariffs to decline from, the mid to upper teens down into the upper single digits to low teens. And that will be a relative benefit if we start to see that easing of tariff policy as we move forward.
Yeah, thanks. Appreciate that.
Sure.
If there's another question that I hear a lot, and I think we all do, is about, you brought it up earlier, in terms of diversified portfolios, large cap growth has done extremely well, large value, maybe small mid, while up, maybe not as much as large growth. One area we're seeing a lot of strength this year is large foreign international investors have done well. Can you give some insight as far as, the dynamics at play there? And is it because the dollar? Is it because international companies are doing better than US? Anything to share there?
Sure. Yeah. So I think you hit the nail on the head there. There are a few things at that's at play here. One is the dollar had been riding high for a very long time. It has declined some this year. That benefits foreign countries. It's just the currency dynamics at play. So that was one of the things there. The other thing is, if we think about the last few years, the US, and look, the global economy hasn't been fantastic, but the US was always the prettiest house on maybe a moderate looking block, right? As we moved into this year, the dollar declining helped, but then also some other countries around the world started to really ramp up their government spending. And so that was going to propel their GDP. So our expectations for GDP growth around the world at the beginning of the year, at the end of last year, were that the US was going to grow farther and faster than all of the rest of the world. The rest of the world has kind of made up a bit of that gap. And so that makes those houses a little prettier. If we continue with a horrible analogy here, maybe they painted their front door and it's starting to look a little bit better. So people start to invest there. We've seen those take a little bit of a pullback lately. I think as we're going through earnings reports during the third quarter, we're seeing a lot of strong earnings reports coming out of the US. And so that's giving investors a bit more of a positive view on the corporate structure and the corporate earnings for the US going forward. So we've seen a little bit of that tone down in the second half of the year so far. But you're right. The beginning of the year, dollar dynamics, and then spending globally to propel GDP for the other countries really propelled the rest of the world, both emerging markets and international developed.
Yeah, thanks, Andrew. A question recently asked to me was about fixed income, and we do anticipate, as you mentioned, a Fed interest rate cut upcoming here in September. As far as portfolio positioning, what's the best place for money to be invested in an interest cutting environment? Should we be more invested in stocks? Should we be more invested in bonds? If there's any tilt that should be in play there, can you talk about that as part of this interest rate cycle?
Yeah, absolutely. And I think one of the keys here that you mentioned earlier is a diversified portfolio, because the market is, for lack of a better term, it moves around and is, I would say it flits between positives and negatives. So as we see the expectation, and right now the expectation is more than an 80% chance that the Fed cuts in September, we want to look at equities and fixed income kind of in separate buckets. On the equity side, the expectation is that this could help out small cap companies. And the reason is, when the Fed funds rate is relatively high, that increases the cost of capital for smaller and mid-sized companies. If that rate comes down, their cost of capital declines, and so their expectation or their ability to fund growth becomes easier for them. So that is a potential if we see further rate cuts. We don't really think that a 25 basis point cut is going to be that impactful to small caps. But if we see more of a rate cutting campaign as we go forward, that could be a solid place to be, and something that we're taking a look at as an investment committee. On the fixed income side, one of the things that we look at are the spreads. And so the yield that you receive from, for instance, investment grade credits, which are very high grade credits, AAAs, AAs, et cetera, and then high yield, which are not as well structured. They're a bit higher risk. When those spreads widen, so that means that you're getting paid a lot more in yield for high yield than you are for investment grade, then that becomes a question: do we want to invest in high yield? Are we willing to take on that risk because potentially the default rates for those companies are lessened? Right now, default rates are relatively low. That being said, spreads are incredibly tight. So right now, we're not being compensated for taking on the additional default risk by going out into riskier credits and into riskier fixed income. So right now, what we like is kind of the intermediate portion of the curve. So that 4 to 7 year bond period. That's what we like, because it's not going to be as impacted by short-term rate movements. And we're getting a little bit of a benefit from the duration play there. The other thing that we like is investment grade. If we're not going to be compensated for going out the risk spectrum, why take that additional risk when we can get a similar yield, similar performance from something that's far less risky? So, that's where we are in the fixed income space. Again, if we see a sustained rate cutting environment from the Fed, if we move into 2026 and we're seeing 50 basis points, 100 basis points additional rate cutting, that would impact our ability, or excuse me, our asset allocation and positioning.
Thank
Andrew,
you.
if I could jump in and ask a question.
Sure.
I know it's probably like a dynamic associated with our monthly meetings that we have, but that I will bring up the strength of earnings, like you're describing, is again likely in the pipeline. Consumer sentiment, which I guess is the substance of my question. The dynamics of market improvements tend to occur at times where consumer sentiment isn't positive, but more skeptical. And is like the quality of consumer skepticism something that's at all measurable? And in my opinion, it makes consumers more discerning for how they do spend their dollars. When they do spend their dollars, their natural behavior patterns are hard to be disrupted. So with some of the clients that might be on the call, you might hear me reference, the time period 50 years ago that the economy was in flux between an ending of a horrible war, a presidential politics that was so dysfunctional, interest rates were super high, and all of those dynamics. The story I tell is, my dad and three other teachers met on the highway for the 20-mile commute to carpool because no one wanted to spend what they had as limited resources for their luxury travel to work each day. So they changed their behavior in the face of their sentiment. I don't see consumer sentiment dipping, but causing a change in the behavior of the people I observe. And does that speak to businesses then having to like earn that dollar when the consumer is kind of set in their ways, but they have to do that profitably? Can you speak to that dynamic and how it affects the markets?
Yeah, I think that's an incredibly, an incredible point that you're making there. And I would kind of draw the distinction between two different things. One is investors and one is consumers. And one of the things that we've seen of late, and I'll talk about investors first, is that the retail investor, so non-institutional money, not hedge funds, et cetera, the retail investor is what's actually been driving a lot of the market performance. So the retail investor, consumers in this case, are the ones who actually have a rosier view of the US stock market than the institutional investors. Now, the institutional investors are starting to come back into the market. That's helping out a lot. But that's been a very interesting dynamic to see investors and retail investors in particular leading the way in terms of returning to the US market. For consumers in particular, you are exactly right. For most of the spending habits right now, we haven't seen an impact. Now, some of that, I would argue, is because we haven't absolutely seen the impact of tariffs and the potential increase in prices that tariffs would have on goods. And so consumers haven't had to change their dynamic or their spending dynamics. One of the things we like to try to track, and we do this through GDP reports, through consumer spending data, is discretionary versus non-discretionary. Non-discretionary spending, things that everyone has to buy, the demand there is very inelastic. So that means it's not going to change based on economic conditions. The discretionary spending, however, we are starting to see a little bit of softness there. And we think that that is really tied into the potential fears around the labor market, the job market, et cetera. So if we start to see that, if we start to see that consumers, I think to your point, are changing their spending habits, then that's probably a canary in the coal mine for the broader economy, because our economy does tend to thrive when consumers, to your point, are spending a lot of money. Think about the markets post-COVID. The economy had a lot of money flowing through it. Consumers were spending, and that really benefited markets and the economy as it rebounded after the COVID shutdowns. So I think that as we track that data, that's a very important indicator for us as we go forward. If that starts to decline, if we start to see the Michigan Consumer Sentiment Index decline dramatically, that's probably going to lead us to want to become potentially a bit more defensive in the way that we're positioning portfolios. But I think you're exactly right. Right now, we haven't seen that. So there's no reason to try to jump in front of that train if it's not actually running.
Thank you.
Thanks, Jack. I want to be sensitive to time here, and I don't know if anybody else has a question or wants to put forward something. If we don't, that's fine. You can ask Jack, myself, other advisors at One Financial. We can certainly get you an answer if something came up that you didn't want to ask or couldn't ask on this call. But Andrew, are you seeing anything else come through on your screen questions?
I am not. I do see there was a hand up, but I believe that was before the meeting started, probably because we were a little bit late getting started. But
Okay.
no, I'm not seeing any questions here. If there are questions, like Rob said, please reach out to Jack and Rob. They can answer those, or we can connect with you at a later date.
Yeah, absolutely. Well, I want to thank you. This has been very helpful, insightful, getting to share LPL Research's your personal take on what's happening in this outlook. It's always good to get together and also introduce you with as many people as possible as an enhanced part of our investment research team. Jack, did you have anything that you'd like to add before we sign off?
I do not.
Okay. Well, thanks everybody. Have a great remainder of the day. Reach out to One Financial if you have any questions after the call. Thank you.
Thanks, everyone.